Welcome everyone to another one of Avant-Garde Trading's free educational trading webinars. Thank you for reading through those disclaimers, and thanks for being here this afternoon. We are thrilled to welcome our guest presenter today, Keith Harwood. He is joining us to speak to us all about why option delta can be more complicated than we might think. We're going to be doing more of a deep dive on trading a technical edge with a focus on option delta, and talk to us about some technical setups, the risks associated, as well as going into a little bit more depth on some of the other Greeks. Keith, are you with us?
I believe so. Can you hear me okay?
There you are. Yes, I can hear you now. Thanks for being here today and for taking the time out of your schedule. We appreciate it.
Absolutely. And thanks for having me. And thanks to those that have joined us today for taking out of your schedules to learn more about options.
Yeah, absolutely. We are excited to have you here. And so whenever you're ready, you can go ahead and share your screen and pull up your presentation. While you're doing that, just a reminder to all of you with us live, if you have questions during Keith's presentation, please feel free to type those questions into the chat box or the Q&A box, and I'll get those over to Keith to address at the end of his presentation, time permitting. All right, great. Keith, I can see your presentation. Looks great. So whenever you're ready, feel free to start.
Absolutely. Thanks again, Natalie. Thanks again to Avant-Garde. And as you mentioned, I'm Keith Harwood, and today we're going to be talking about why option delta is more complicated than you might think. So a lot of people use the option delta as a basis for their trading, and you may be surprised to learn that oftentimes that option delta can change significantly, not just from a change in the underlying price, but also from some of the other inputs into the option model. So with that in mind, let's first talk about the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Option Hotline is not an investment advisor, not registered with the SEC or FINRA. Make sure that you talk to an investment advisor if you have questions about your personal financial situation. I'll give you all a moment here to read through the rest of these disclosures, and then we'll talk more about options trading and that focus on option delta. All right. So for those of you that are not familiar with me, this is me, Keith Harwood. I started my career in the option pits of the CBOE back in 2005. So coming up on 20 years now, 19 strong, one to go, and then I'm at 20 since I've been in the trading world. So I was a market maker on the CBOE floor through the subprime crisis that seems oh so long ago. 15 years now, really, since the subprime crisis was wrapping up, and we've really had a fairly bullish market on the whole since that time. We've had some blips here and there, but overall we've had a very bullish market, a lot of wealth growth in the stock market, and that's caused a lot of excitement for a lot of people in learning how to leverage the return of the stock market in their investment portfolio. As markets were changing from that collapse in the subprime crisis, they started to tighten up, get a lot more electronic, and become a lot more friendly for retail investors, and less friendly actually for the market maker in the style that I was used to. So the market making community converted more to a pure volume game, trying to capitalize on tons and tons of option volume, and less on the knowledge of the options risks and the Greeks and everything else, which I found more interesting. So as a result, I moved away from trading wider markets that existed during the subprime crisis and before the markets got fully electronic, and started looking at proprietary trading strategies that really structured based upon other edges that I could take advantage of in the options markets, skew, term structure, just pure volatility bets, et cetera, et cetera. Recognizing that the one thing that I didn't have a huge edge on was the direction of a market. I went to the University of Chicago and earned my MBA. And after that, I joined a CTA, a commodity trading advisory. And CTAs are hedge funds that are primarily focused on commodities and often well known for being very technical in nature. So the company that I joined taught me a lot about technical trading as well as fundamentals of the commodities. And I worked with them on improving their option strategies and the ways to leverage a directional move given the inputs that they had, price targets that they had, and the options market that we were presented with. After a number of years working with them on that and learning a lot more about technical trading, I decided that it was time to come back, go over to the retail side, the educational side, and teach others that there are ways to trade smarter, to leverage all of the inputs that we've got into the market, and try to give back some of this knowledge of how we can all trade smarter and how we can put on more higher expected value, higher probability trades in the type of market that we continue to see here that has good liquid markets and good leverage opportunities. So that's why I'm here today, is to continue to share some of that educational benefit and talk to you guys about ways that I have used options to leverage potential moves for myself and for teaching others how to do it for themselves as well. All right. So with that, if you do have to leave early, you can always email me, keith@optionhotline.com. I'm always happy to take questions, to start up a conversation, to discuss options markets, resolve some thoughts that you might be having. We can, kind of spitball, go back and forth a little bit on the options markets. You can call me 312-600-8004. That's my direct line. So give me a call, especially during market hours. I'm available. Outside of market hours, it's easier to reach me via email. And I almost always reply within 24 hours, even if it's the weekend. But, I'll do my best to get a hold of everybody if there's a flood of emails that come in. Also, make sure you keep an eye out for support@optionhotline.com for free giveaways. I got a couple coming your way as a result of you joining this webinar today, and I hope you're all excited. As a reminder, if you have questions throughout the presentation, please feel free to post those in either the Q&A box or the chat box, and Natalie and I will make sure that we get those resolved here before we sign off for the day. So I'll do my best to get all your questions answered as long as we have time. Speaking of time, we do have a number of things to talk about today. So I always want to introduce why I use options in the first place, because everybody always tells me, well, the simplest thing is to buy stock. And they're absolutely right. Stock is the simplest, but is stock the best? There are reasons to use options. You don't use a hammer for every construction project. Sometimes you need a screwdriver or a power drill or a saw or whatever else. So sometimes these options can be very valuable tools. Most of the time, they can be very valuable tools if you know your inputs and you know your trade parameters well. We'll talk about the options Greeks with a focus on delta. As I mentioned, delta is one of the easiest to understand Greeks, and yet it's more complicated than I think most people give it credit for. There is more to it than just the basic definition that we'll get into today. I'll touch a bit on trend trading signals, and in particular, how I trend trade with a focus on the option delta. So what is my general strategy for a delta-focused trend trade? We'll talk about that a bit today. And then what about the other Greeks and how do they impact the delta of an option? Like I said, I think many of you know that the delta of an option can change with the underlying price, but delta can also change with a lot of other factors in the markets, including changes in implied volatility, passage of time, et cetera, et cetera. So with all of that in mind, let's first get started on why I use options. So for those of you that have been more focused on using stock, you're generally familiar with the concept that buying stock is a very linear payout. Every dollar that the stock goes up is a dollar of profit. Every dollar the stock goes down is a dollar of loss when you own that stock, okay? If I have $10,000 in my account and I am willing to risk 10% of my account on one individual trade, which is a substantial amount, obviously, but let's just say that I'm willing to risk $1,000 for argument's sake here. Then I could buy $10,000 worth of $100 stock, also known as 100 shares. And if the stock goes down to $90 per share, I've lost $1,000. I need to exit. All right. That's the basic part of it. The first part of it, the risk is always first. But if my goal or my expectation is that the stock is likely to go to $120, then my potential upside is $2,000. But that's again assuming I exit at my stop loss or I exit at my target price. There is technically unlimited upside until I've exited. If the stock goes to $120 and I decide not to sell and I hold on for dear life, and the stock goes to $500 a share, I'm now going to make $400 per share, $40,000. It's not likely. It happens sometimes, though. GameStop people may be familiar with that kind of move, the parabolic move. On the downside, I would like to exit at $90. That is my stop loss, but at the end of the day, I have to execute. If I have a stock that has bad earnings and opens up tomorrow morning at $85 per share, I can't sell it at 90. I'm going to have to sell it at 85. That means I've lost $1,500, not the $1,000 I had capped myself at. That risk is really all the way down to potentially zero, because you never know if some sort of piece of news can come out in any given stock that sends a stock to zero. Doesn't happen often, but when it does, it hurts if you're long. All right. We saw it with the inverse VIX ETFs a few years back, where these $100 ETFs were all of a sudden trading for single digits. It can happen that you get a 90% plus loss from some unknown input into the market. So at the end of the day, I can target my stop loss at $90, but it's not a hard stop until I've actually gotten through my exit process. And I can target my upside to $120, but it's not a hard exit until I actually execute. Options, on the other hand, take care of one of those elements for me. So this is the payout of a call option at expiration. A call option gives me the right, but not the obligation, to buy the stock anytime before expiration for a set price, the strike price. In this case, this is the graph of the $100 strike price call, which means that if the stock is trading at or above $100 at expiration, I will exercise this call and buy the stock for $100. So if the stock's trading $101, of course, I'm going to exercise the option to buy the stock for $100. If I don't want to hold on to it, I just sell out the stock for $101 per share and capitalize on that dollar difference. Because it's giving me an option to do something and not a requirement, I do have to pay a premium for it, such like an insurance contract. Okay. It's giving me insurance to the downside, because if the stock's trading below $100, I don't exercise my call. And it's giving me leverage to the upside, because I can actually afford more of these calls than I can shares of stock. But if this, in this case, I've priced these options, these theoretical options, this example, to have the premium be $5 per share. Each option represents 100 shares. So each option contract costs $500. If I want to define my risk as $1,000, I can do so by buying 2 call options for $5 a piece to represent 200 shares of stock for $1,000. That gives me more upside, because now if the stock goes higher, I can buy 200 shares for $100 a share. It gives me defined risk to the downside, because I can only lose $1,000. If the stock opens up at 85, 60, or 0 tomorrow, I don't exercise my calls. I don't have to buy the stock. I just lost what I paid. I didn't want to lose what I paid, but at least that's all I lost. I didn't lose more. The trade-off is this. I've got leverage to the upside because I'm long 2 calls, but I've initially paid $5 per share. So if the stock does not go up, I lose money. If the stock is trading $100 still 1 month from now, I lose $5. I have to get to $105 per share just to break even, because I paid $5 per share for that call option. So what I don't want to see happen when I'm buying options is the stock not moving. What I do want to see happen is the stock moving the direction I'm expecting to get that leveraged return. All right. That's the nut of it. I want to see a large move to the upside when I buy a call option, and flat or down is wrong. When I buy stock, flat or up is right, and down is wrong. When I buy an option, flat or down is wrong, and up is right. And up has to be enough, because if this stock goes up 2% to $102 per share, I still lose money. That's one of the most painful things for, I think, option traders to first learn, is that you can lose money even though you were right. So what people often do in options is they do a thing where they improve the odds of success in their options by buying lower and lower strike calls. The stock's trading $100. Instead of buying the $100 strike calls, I can buy the $90 strike calls. I no longer need as much of a rally for the stock to break even, or for my options position to break even. But I have to pay a higher premium. This costs more because they're more likely to finish in the money. These are higher delta options. So the further in the money an option gets, the higher the delta gets. And we'll come right back to that here in just a moment, because first I want to talk about what goes into these option valuations. All right, the most well-known option option pricing model is Black-Scholes. The formula has 5 inputs to calculate the value of an option. The first is the underlying price, which is given by the market. There's the strike price, which is given by the market. There's the time to expiration, which is given by the market. There's the risk-free interest rate, which is given by the market. And there's the implied volatility, which is estimated by the trader. Okay. All these other things are given by the market. And we know that the underlying price is going to be driven by technical trading. But at this moment in time, that is set in stone. It can change, but it is set in stone. The implied volatility, though, is this market element that gets estimated. Now, the market is telling me what they think that implied volatility number should be. That's an expectation of future volatility. It's constantly changing based upon the money flow. So when somebody comes in and they start buying call options, what it means is that they expect the market to move more than is currently being priced in. Implied volatility tends to rise in that scenario. Much like the underlying price moves when people are buying stock, implied volatility rise is when people buy options, whether they are puts or calls. Okay. The VIX index, as you may all be familiar with, is an index that tells us what the current market is expecting for future S&P 500 movement. So the VIX is tied to the S&P 500. That's crucial to know. It's a broad market index as opposed to purely on tech, like the NASDAQ, or small caps, which we've seen moving a lot here the last week. This is based purely on the S&P 500, one of the biggest indexes, one of the biggest markets in the world. It's often referred to as the fear index because it goes up when markets are panicking. People buy options most often when the markets are panicking and dropping. Why? Well, they want that defined risk. Okay, so you want that defined risk when the market's falling. And you can do so by either buying calls instead of buying stock, or to protect your long position, start buying puts. What people tend to do, right? When the market is lower, people then start to expect a larger magnitude bounce back if the market recovers, thus buying calls. People replace long stock positions with call positions, thus buying calls. They define their risk by buying puts. All of this leads to a higher VIX. That fear index can explode. Realized volatility is what we have seen occur recently, while implied volatility is what we expect in the future. Realized volatility doesn't guarantee future volatility. Just because Charles Schwab stock was down significantly today does not mean it will be down significantly tomorrow or up significantly tomorrow. Why not? Well, frankly, there was an input. Earnings came out. That hit the stock. That caused it to move. Earnings are not going to come out again tomorrow. Earnings will come out next quarter. So once these fundamental inputs come in, they get priced into the market, causing movement. People then reduce the implied volatility for future movement because there's no longer an expected unknown. So earnings announcements or FOMC announcements, things like that, they're expected unknowns. Unexpected unknowns would be technical triggers often, or just outlier events. Obviously, what occurred this just a few days ago here with the attempt on President Trump's life, that was an unexpected unknown by the market. It actually turned into a rallying situation for the market overall, it seems, but we don't know how those kind of reactions are going to come when they're unexpected unknowns. The expected unknowns like earnings and the Fed, they're on a calendar. We know they're coming before they show up. We knew Amazon Prime Day was starting today. We've seen enough commercials for it, even though I don't see very many commercials now with streaming. We knew last week that Nordstrom was going to have their anniversary sale. These are expected unknowns. The information that comes from that is already being priced into the options market, even though it's not into the underlying market. Okay. That's why the VIX is important. That's why volatility is important. And that's why it can create an edge, is when you know something is not being priced in, given its potential for movement. And that's why I love these technical signals when I'm trying to make a options trade, because technical signals don't trade on a calendar basis. They trade based upon a price or a formation occurring, right? So as I see that formation coming up, I know in my mind what price level is going to potentially trigger some price changes, but that's not something that says on July 17th, we're hitting technical indicators. No, it's going to happen when it happens, when the market lets it happen. All right. So what are the option Greeks associated with all of these inputs that we've got to the marketplace? Well, the option Greeks are the derivatives, the mathematical derivatives that estimate the P&L, the profit and loss impacts of various shocks to the market on your option value. All right, these are the things that change the value of your option directly. The underlying price movement is delta. That's what we're focusing on today. That is the change in the option value relative to the change in an underlying price. So if you have an option that is referred to as a 50 delta option, an at the money option, such as a $100 call and a $100 stock with a month expiration, that's expected to increase in value by 50 cents every time the stock goes up $1. Okay, that is the ratio of the return in the underlying that is going to hit your account as an unrealized gain until you close it. However, certain things can reduce or increase the value of the option absent underlying price movement. Passage of time. Options decay in value over time. This is crucial to understand. When you are long options, they become less valuable as time passes. That is theta. Options decay over time. They are insurance contracts by nature. Okay, so an insurance contract that is, say, a whole life insurance policy is going to be significantly more expensive than a term life insurance policy. Eventually, we're all going to die. Whole life insurance is eventually going to kick in. It's just a matter of when. If I have a 10-year term life policy, a 10-year term insurance policy, I may or may not pass away in those 10 years. I hope not. I hope I've got a lot more years than that. I hope we all do. But that's why these contracts do expire worthless or expire in the money. I hope my life insurance policy expires worthless, and I hope my call options expire in the money. The risk-free interest rate is actually meaningful now. For years, it was basically 0%. Now interest rates are higher, although there is speculation that they will be lowered eventually by the Fed. But we keep talking about it, and we'll see when the next interest rate drop comes. But that can impact the value of an option, particularly longer-term options. And by longer term, I'm talking 6 months, 1 year, stuff like that. This row impact is also often looked at when dealing with dividend changes. So some stocks do have variable dividends, and that row risk is often lumped in with interest rates as well. Finally, on the first order Greeks is that implied volatility that I mentioned. This is called vega, the change in option value relative to the change in implied volatility. So as implied volatility goes up, that's going to increase the value of your option. As implied volatility goes down, that's going to decrease the value of your option. So even though you may have a stock that has not moved, you could say, I should have broken even today because the stock didn't move. My delta had no impact. But the stock dropped in value because of theta, and maybe it dropped in value because implied volatility dropped too. So all of a sudden you see this big loss to your portfolio if the option trade is executed wrong. Or sometimes you see a situation where people start buying options expecting a move. And so because of implied volatility rising, you actually make money in spite of the option, the stock not moving. It can go either way. It all depends upon the market flow. And then the second order Greek that I want to touch on first is going to be gamma. And there's going to be a couple of others that I touch on today related to delta. But gamma is the change in your delta relative to the change in underlying price. This is the most familiar second order Greek for most, because it is how my delta changes, how my exposure to the market changes once that underlying price has changed. But again, that delta can change from passage of time, and it can change from implied volatility. And we are definitely going to touch on those today because I want to make sure you guys fully understand how your delta can change and how your market exposure changes as you are actively monitoring your position and as new inputs come into the options markets. All right, let's just visualize this delta for the market, okay? At expiration, we already know what that call option looked like. That's the blue line here. Every dollar the stock goes up, the dollar is $1 appreciation in the value of the call. Okay, this is the P&L of that $5 option. I lose $5 at $100 per share. I lose $5 anything under $100 per share. At 105, I break even, and everything above 105, I am running in parallel to the stock price. But I got time on my side. If I'm looking at the P&L today, 30 days to expiration, it's no loss. Now, if the stock starts to drop significantly, you can see that I'm going to start losing value here. The delta is the slope of my payout, my P&L graph, okay? Here, it's the same as the slope of the stock. Here, it's changing. At $100, my slope is 50%. The stock goes from 100 to 101, I'm going to make roughly 50 cents on the dollar. From 102 to 103, I'll probably make closer to 60 cents on the dollar. By the time we're reaching 116, 117, 118, I'm making roughly dollar for dollar on the upside. The hedge position is the put, the short delta, okay? So short delta is my hedging position. It's the mirror image of the call for the put. Okay. Every time the stock goes down, it's dollar for dollar to the downside at expiration. But before expiration, 30 days to expiration, it's 50 cents on the dollar when we're at the money. As it gets in the money, it becomes dollar for dollar. And as it goes further and further out of the money, it gets closer and closer to no change. Effectively, this option stops decaying because it has already lost its full premium once we get all the way $20 out of the money on the put or $20 out of the money on the call. I've taken my max loss. Okay. Another way to look at this delta is how rapidly it moves right here. You can see the call option delta over price and time. At expiration, it's either 0 delta or 100 delta. I'm either no position or I'm a stock position. But as I add time to expiration, I start to change how quickly I'm moving. With long time to expiration, it's pretty close to a linear thing. The delta stays pretty consistent, but it is increasing as the stock goes, the option goes further and further in money and the stock goes higher. And as we get closer and closer to expiration, you can see that that delta increases more rapidly. And we'll talk about why that occurs and where that is for gamma, Vanna, and charm are the other two second order Greeks that we're going to be talking about and as a little preview, but we'll talk about those here in just a few slides. All right. So what does delta really mean now that we've looked at some sort of visual representation of it? Well, there are 3 definitions that I really like for delta. And I think that for each person, one of these definitions probably becomes the dominant. This is what I understand. This is how it makes sense to me concept. The change in value relative to the change in underlying price is the most normally considered definition of delta. And that's the one that I think resonates with most people. For market makers, we had a strategy called delta neutral trading. We wanted to be exposed to all of the Greeks of trading except for delta. When somebody comes in and says they're going to sell me calls, I'm not expecting them to be selling calls because the stock is going up. I expect them to be selling calls because they're concerned that the stock might stop going up or might go down. So why would I want to expose myself to long delta if the market is telling me that either the implied volatility is too high or the stock price is too high? Well, I'm a market maker in options. I know a lot about options and I don't know a lot about the direction. So I'm going to hedge off my delta exposure. If I buy 150 delta calls, I now have max exposure of 10,000 shares. But at the time of the 50 delta, I've got exposure of 5,000 shares of stock. If the stock goes up $1, I'm expecting to make five grand. In order to hedge that, I could just sell 5,000 shares. And now when the stock goes up $1, I don't make or lose anything on the underlying price movement until I start trading around other Greeks. Okay. So, but for the price movement, I'm no longer exposed to that. I can focus on trading implied volatility, realized volatility, skew, all those other elements to options other than direction. Okay. That's why the hedge ratio is one of the preferred ways to look at it from a market maker's perspective. This is what the market makers are going to do if they get hit with this position. So when you see somebody going into the market, buying calls, buying calls, buying calls, buying calls, and you see the stock price go up along with it, it's not because there's necessarily one person both buying calls and stock, although that may be occurring. Every call that those market makers are selling, they're turning around and buying stock to hedge it. So when somebody goes out and buys 5,050 delta calls, somebody's got to go out there and buy 250,000 shares of stock to hedge it. It's a pretty big impact on the underlying market. And finally, this is one of my favorites for those of you looking to trade the offset between expected value and large returns versus probability of returns. So expected value is really the probability of a trade working out times the magnitude of that payoff, right? If a trade has a 20% chance of working out, but when you're right, you make 10 times your money, it's still a net expected value that is positive. If you have a trade that is 80% probability of working out and doubles your money, it is a very positive trade. 20% of the time, you're still going to lose money. But overall, in the long run, repeating that over and over, going to make money. What kind of trader are you? What kind of trader do you want to be? Do you want to be that guy that hits home runs, or do you want to be the guy that hits high average, lots of singles? That's something for each of you to determine for yourself. But the proxy for the probability that option will expire in the money is a really good tool for that. If I prefer to trade for high probability, then I want to trade higher delta. That means in the money options, $100 stock, I'm looking at maybe the $95 call or the $90 call. If I'm looking for big leveraged returns, I'm looking lower delta options out of the money. 30 delta option might be trading for a $105 strike in a $100 stock. It's only got a 30% chance of finishing in the money, and even lower chance of finishing profitable, because in the money doesn't mean profitable, as we know from our previous chart. In the money means it has a value at expiration. Profitable means it is worth more than I paid originally. All right, so a 50 delta call has a 50% chance of finishing in the money, but we also know that I still have to get that $5 rally to be profitable. So remember that when you're going through the delta of being a proxy for the probability that reaches expiration in the money, it's going to be the odds of success on your trade are going to be slightly lower than the delta if you are buying premium, and slightly higher than the delta if you are selling premium on average. That's why I tend to look for options where I have a little bit of a benefit where I'm buying implied volatility when it is lower than it should be, or selling implied volatility when it's higher than I believe it should be. Now, the way that I tend to find that probability is by going through my trend trading signals. I don't want to spend too much time on that today because I still have some stuff to talk about with Delta. So I'm going to send you my 5 indicators for trading success ebook separately. This walks you through the indicators that I use on a technical basis to find my trending trades. Okay, so that's just my signals. It's free. It's coming from supportedoptionhotline.com. It should be in your inbox tomorrow. That's going to give you the way that I look for a technical signal. All right, I could do a whole webinar or probably 5 webinars on these indicators just to kind of walk you guys through it. But instead of doing that today, I'll just send that separately. So keep an eye on that from your inbox. Back to Delta. This is how I use my options for the trending markets. I'm using those in the money options. I mentioned 65 to 80 Delta options. These are calls that are already in the money, already going to expire with value if we reach expiration today. But I want more time. I want 3 to 5 months to expiration so that I can allow the trend to work. Okay. And the triple moving average signal is something that I outlined in that ebook that you're going to get tomorrow. So if that's not familiar for you, take a look at that tomorrow and you'll have a little bit better understanding of why and how I'm using these in the money options with 3 to 5 months to expiration. So those second order option Greeks that are changing the delta. So I'm starting off at 65 to 80 delta, and that delta is going to change as the price moves. That's my gamma. As the implied volatility changes, that's my vana. And as time passes, that's charm. This is why option delta is more complicated than you might think. Delta changes not just because of gamma. It changes for other reasons too. Let's visualize how gamma works. Gamma is often referred to as curvature. You can now see why maybe it's referred to as curvature, because it is the slope of this line right here is giving me my gamma. At $100, that slope is 50 delta. As $102, it is now probably 60 delta. So that change there on the slope, the change in the slope goes from 100 to 102. That's gamma. It's the curvature of this option. At expiration, the gamma is basically 0, right? It's a line. The curvature here exists prior to expiration because the delta is shifting up and down. Another way to really look at this is to say, as the option goes up and as the delta is shifting, where is the most rapid move in delta? Well, with 1 day to expiration, it's basically 0 or 100. So at $100 is my delta change. For trading at 99, it's a 0 delta. At 101, it's a 100 delta. At $100 is the inflection point, and it is basically vertical. Okay, that change in delta is gamma. My change in delta, the slope of this line with 33 days to expiration, is steepest at $100 again. As the price continues to go higher, you can see that delta goes up slower. So because the delta is going up slower, that tells me my gamma is lower. Gamma is highest in at the money options. By buying an in the money option, like a 65 delta option, equivalent is saying that if I have a $100 call, the stock is trading something around maybe $108. So you can see that delta is changing less aggressively. Actually, I could say here, right here, 70 delta, $106 a share. You can see that on a move from 106 to 110, my delta has changed from 70 to 80. But when it goes from 100 to 105, it goes from 50 all the way up to 70. So it's increasing by 20% on the first $5, 10% on the next $5, 10% on the next $7. And then that last 10% takes a long time. Gamma is highest for at the money. So when I'm trading an option that is at the money, I'm going to have the biggest shift in my delta as the price moves. This is part of why I use those 65 to 80 delta options. The delta is going to change less significantly on a price move in general in those smaller price ranges than it is going to here. And so I'm not changing the Greek profile of my options as significantly. All right. I don't want to be aggressive with gamma and paying theta as I do in other types of strategies. In the trend, I want to have a more consistent position that I don't have to change frequently. If I want to visualize Vana, which remember, Vana is that change in delta relative to change in implied volatility, I can look at this chart right here. Okay, so we know that as the stock goes up, that delta is increasing, right? But also as implied volatility rises, that delta does something. And if it's in the money, let's say the stock's trading up here at that $110 level, these calls go from 70 delta to 80 delta to 90 delta, close to 100 delta as implied volatility drops. So as implied volatility drops, what it's telling me is that the stock is less likely to move significantly. That's what people are pricing in. So if a stock is less likely to move aggressively from the current price of $110, it means that's more likely for a $100 call that's already $10 in the money to finish in the money. And as implied volatility rises, we're looking at much more potential for large movement, which means the stock could either go up or down. And if it goes way down, that implied volatility being higher is going to be accurate, and my delta is going to drop, and the probability of this finishing in the money lowers as implied volatility rises. However, on an out of the money option, as implied volatility rises, my delta rises. Because now that we're out of the money, I'm looking at the odds that the stock can move way up to knock this option in the money. If a stock trading $90 and has very low implied volatility, it's not likely to rally 10% in a short time period. But if a stock has a high implied volatility, high expected movement, it can have an increased odds of finishing in the money because there's an increased odds of a 10% move that puts it in the money. All right. So higher implied volatility means higher delta for out of the money options and lower delta for in the money options. Lower implied volatility is lower implied volatility on out of the money options and higher delta for in the money options. So you can see that it's not just straight up, oh, I've raised implied volatility, it's going to raise my delta. It depends upon what side of the strike you're on to determine whether or not that's going to happen. That's some of the complexity with delta. If I start seeing a market that's expecting to be more volatile, my option value might be increasing, but at the same time, my delta is decreasing. Now my Greek exposure is higher to Vega and lower to delta, and the price didn't move. That's why it gets interesting trying to trade these dynamics with options, okay? When you're trading an outright option, you could see your Greek risk shift simply without a single change in the underlying, simply by a change in implied volatility or by a change in time. Passage of time changes the delta. Why? Well, likelihood of a stock finishing in the money when there's less time to expiration increases or decreasing, again, depending upon what side of the strike you're on. At $90 a share with 1 day to expiration, that option is very unlikely to finish in the money. But if I've got 3 months, there's a chance, 20% chance that it finishes in the money in this model. With the other side, $10 in the money already, it's pretty much going to finish in the money with that last date expiration, barring some significant news or major market crash, almost 100 delta. But as I increase time, lower chances of finishing in the money. So as time passes, this first month, for example, we go from, say, 82 delta up to 88, up to 95, and up to 100. Every month, the delta increases, and it increases more rapidly at first and then slows back down at the end, partially because we're already at 100 delta when we're further out of the money. So you can see that when it's right barely in the money, the change in that delta is almost parabolic as we get close to expiration. It's a slight increase in delta, a little more rapid increase in delta, and then a very rapid increase in delta. Farther in the money, most of that's already been priced in, even with a month expiration, because at that point, there's still a high likelihood of this finishing in the money because it's so far in the money. that gamma move has already taken care of the rest of the delta. It's already there. You didn't really need 33 more days to pass to get to 100 delta. We were already pretty well secured. All right, so you can see overall how these option deltas are changing based upon the price movement, the implied volatility movement, and the time movement. And that's why delta is really important to look at when you're trading these options, because you want to know how exposed you are to market movement, not to option market movement. Oftentimes people are using these options to express a directional view, particularly with the trending market. So a reminder, that's why I'm using 3 to 5 months to expiration. That's why I'm using in the money options. I'm trying to reduce some of the other elements, some of that Vana, some of that charm, and some of that gamma to focus on delta. Now, if you have more questions about this, you should always certainly reach out or post questions now. Contact me, Keith at optionhotline.com. Call me 312-608-8004. And then keep an eye out for support at optionhotline.com for those free giveaways. I mentioned the 5 indicators, and I got another special giveaway in there. So make sure you watch your email tomorrow. If you have questions right now, feel free to hit me up. If not, something comes in your mind here 6 hours from now. You're going to sleep and you say, gosh, I really want to know more about charm. So we're all unique on our questions right before bedtime. Email me, Keith at optionhotline.com. I'll get back to you in the morning. Make sure that you've got this all understood. But if you have questions right now, I'm happy to take them. All right. I think Natalie may be having some microphone issues here, but that's okay. Right now, I think that it looks like we may be in pretty good shape on the questions. If anybody has any here, I'll give you guys a moment to talk through those, but definitely make sure you're watching your email tomorrow. Sometimes these emails do hit a spam
Hey,
filter.
Keith, can you hear me now?
Oh, I can hear you now, Natalie. Yeah, sometimes these emails do hit a spam filter, so make sure you've got an eye on that folder as well.
Yeah, sorry
Welcome
about
back,
that.
Natalie.
Yeah, you can hear me okay now, right? Hello?
Yes, I can hear you, Natalie.
Okay, good.
Yeah.
Sorry. I had some technical issues on my side with the Zoom, but should be working now. Thank you, everyone. Sorry for that messiness. Yes, Keith, thank you so much. That was a ton of great information as always. I'm going to ask you to leave your screen up for another minute just so everyone can write down your contact info. Shout out to Robert. Thank you for acknowledging you can hear me. Appreciate you. So yeah, that was a ton of great info. Thank you so much for presenting on all of it. And actually, that was a little more in depth on a couple of the lesser known Greeks than we usually get to hear. So thank you for going in a little deeper on that. And we are getting a couple of questions here. So I'm going to field those over to you. Just a reminder, if you have questions that are specific to your own portfolios, please reach out to Keith on your own time. These are for just generalized questions. Let's see, we've got a question about how do you feel about delta starting out in the 90 to 100 range?
So starting in the 90 to 100 delta range is going to increase the cost of the option, or it's going to be significantly reducing the amount of time you have to expiration. So if I go back here on the chart here, so we've got the call option delta over price and time. One way to get towards 90 delta is to reduce the amount of time. 100 days to expiration, it would be about $15 in the money, or 33 days to expiration, it would be about $8 in the money. So either way, that's going to increase the cost relative to a 65 to 80 delta option. Part of the reason I like 65 to 80 delta is it does help reduce some of the cost, but increasing the delta does reduce some of those secondary risks, that gamma, that Vana, that charm. So there is a benefit there. If you want pure delta stock replacement, then that's how I would trade it, as well as looking towards a 90 to 100 delta option.
Okay, thank you, Keith. Along those lines, someone else asked a similar question on the other end of the spectrum, asking about a 50 delta.
So
you want to add on?
It's the exact opposite. 50 delta is going to give you the highest risk. So 50 delta is going to expose you to the most gamma, the most Vana, the most charm, and the most from the other Greeks as well. Some of that Vega risk can really kick in as well when you're dealing with at the money options. Theta is the highest there, especially on short-term options. So in order to balance some of that out, that's why I like to use those in the money options that increase the odds of success, going from 50% chance of finishing in the money towards 65, 70, 80% chance of finishing in the money, reduce some of the other risks, and focus on the delta in a trend.
Okay, sounds good. Thank you, Keith. We're pushing right up against our time frame here. So can you go back to that last slide with your contact info just one more time, please, so everyone can write that down. And just a shout out to you, Keith. We've got some people in the chat just complimenting you about the presentation and just feeling like they learned a lot just in this afternoon session. So thank you very much for doing this. And thank you all for those of you who are with us live. We appreciate you asking questions and being engaged. And we hope to see you back here at our next Avant-Garde Trading webinar, which will be coming up in the beginning of August. So go to our site, sign up, and sign up for our emails so that you can be notified about the next webinars. And Keith will definitely have you back on. One other question coming in. Yes, this presentation is recorded, and we're going to send out an email tomorrow to everyone with the link to the recorded replay. That email will come from info@tradeagt.com. So make sure you check your inboxes tomorrow afternoon for that link. Thank you, everyone, and we'll see you at the next webinar. Good trading.